Okay. All right. Any other questions on what we were talking about there? All right, so let's go ahead and let's get now into year 2 of this company. This is year 2, and we have what? Revenue 21. We sold 7 lemons. 7 times 3 is 21. 7 lemons, $1 each. Cost of goods sold is $7. Our gross profit is what? 14 now, right? Then what happens? Then we go to the fertilizer store. And we say, hey, we want to put the fertilizer on there because that worked last year, right? So we go to the fertilizer store, and the fertilizer store owner says, hey, aren't you the lemon dude? And I say, hi, what? You're that person that spins them lemons and people come and pay $3 a lemon for that, right? Is that you? And you say, well, yeah, I heard about you. He says, I'll tell you what, I'm not going to charge you for the fertilizer yet. Okay, take it home. I'll send you a bill and you can pay me. Take it back to your business. I'll send you a bill and you can pay me next year. Now, why would the fertilizer store operator, owner be interested in doing this? What's in it for him or her? Yeah, he or she's being their own entrepreneur, looking ahead, saying, okay, you know what? This guy's a happening. This is the second year he's come in here. I've heard about him. I bet you he's going to get like 2 or 3 lemon trees going. He's going to need a lot more fertilizer. I want him to feel like I'm his guy. I'm his person. When he needs fertilizer, he comes to me, right? That's what made America great, not Trump. Okay, it was what? It was this idea that we could have credit and you could get things without money, right? Okay, and I talked about that before. So what happens? I say, okay, great. So I take the fertilizer. I said, bill me later. I dump the fertilizer on the ground. Is it still expired? I dump it on the ground. Is it still expired? It's still dumped on the ground. It's still expired. So even though I haven't paid for it yet, I still go ahead and take the expense because it is expired, isn't it? And I owe the guy $7, don't I, for that when he sends me the bill finally? Okay, so I have what? Gross profit. I have my expenses of $7. My net income is $7. This is for year 2, isn't it? Year 1, how much was it? Year 1, it was 3. Year 2, it's 7 now, right? Okay. Now I come over, I prepare my balance sheet. Let's look at my cash. My cash is now what? Is now $29. How did I get my cash balance? Okay, well, I had at the start of the year, now where's my clicker? There it is. I had at the start of the year what? I had $8 at the end of last year. $8 at the end of last year. If you fall asleep on New Year's Eve with $8 in your pocket, in your wallet, whatever, how much should you wake up with the next day on January 1st? $8 unless you've got some really unscrupulous friends who snuck in and took money out of your wallet. But you should have $8, shouldn't you, to start the new year? Okay? So I have my beginning balance of cash. The beginning was what? $8. I sold how much of lemons? How much did I sell of lemons? That's a question. How much did I sell of lemons? $21. So I've got my cash sale of lemons, don't I? Of 21. So I didn't spend any cash. I don't subtract the $7 for fertilizer because he didn't make me pay for it. She didn't make me pay for it, did she? At the end, when I went to the fertilizer store? And so I don't subtract that $7. So now my cash is what? 29, isn't it? My cash is 29. Beginning plus the $21. I haven't paid for the fertilizer yet. Question?
But what about the cost of growing or cost of goods sold?
Well, we're assuming that these are the world's longest lasting lemons here, okay? And so it's the same 20 lemons that I started with, and I just sold 7 more out of the 20. Okay, so those are lemons that I started with, and when I issued the stock, I took lemons in exchange. So remember, at first all I had was $20 worth of assets of lemons, right? But now I've sold some of them off. I'm getting some cash into the company, but I'm still left with 8 lemons. I had 20. I sold what? Was it 5 the first year? 7 the second year, that's 12. I can do that one in my head. 20 minus 12 is 8. So there's 8 lemons left. Those are still now what's left of those first 20, and they're not rotting. In this case, we got some technique for keeping our lemons fresh over years and years of activity, okay? Obviously, this is not a fully realistic example, okay? So I've got 8 lemons left. So are those 8 lemons an asset? I can still sell them, right? Cash is an asset. It's your favorite asset. So that gives me total assets here of what? 37 right now? Okay, then what? Then I come down to my liabilities, and when I look at my liabilities, nothing like light to make you see you got strings hanging from your shirt, okay? But what happens, we look at the liabilities, and remember that fertilizer store manager, operator, owner is going to send me a bill at some point, aren't they? So do I have any liabilities? I've got $7 of liability. My common stock is still what? Still 20. I haven't issued any more stock, so that's still sitting there at 20. And my retained earnings is now 10. Now, when I look at my retained earnings, I have what? The beginning balance of retained earnings, which was last year's ending balance. Last year ended with what? Ended with a retained earning balance of 3, didn't it? So year 2's beginning balance is 3. I add my net income. How much is my net income for year 2 now? $7 for year 2's net income right there. And assuming I subtract my dividend is 0, then my ending balance in retained earnings, ending balance, END balance is going to be $10, isn't it? So my ending balance retained earnings $10. Beginning balance from year 1 plus year 2 net income minus any dividends, which right now we're saying we have 0, gives me what? An ending balance of 10. I put that on my balance sheet. Does the balance sheet balance? 7 plus what? Plus 20 plus 10 is 30, gives me 37, doesn't it? What's my total assets? 37. Does the balance sheet balance? Okay. Okay, good. Now, let's take a look at how dividends might affect this whole thing. Let's take a look at how dividends might affect this whole thing. So what happens? I'm sitting there, and I did this because I wanted to be richer because I didn't have any money. I was sitting in my house. Remember how this whole story started? But right now, all I've got is this $29 of cash that are sitting in the corporate accounts. And I say, well, you know what? I still can't even buy a root beer with the money that I have in the corporation. So I'm going to draw out $1. I'm going to pay myself a dividend of $1. Okay, so I go ahead and I pay that dividend of $1. Now, when I do that, the amount of cash that I have goes from 29 to what? Goes from 29 to how much? If I pay $1 dividend? To, are you guys shy? Is that what it is? I mean, you're not shy entrepreneurs, are you? Okay, I mean, just call it out. What is it? It's $28, right? Okay, then what? The lemons are still $8, so that gives me what? 36? 36? Okay, then what? I still have the $7 liability. I still have the common stock of 20, but if I've paid a dividend of $1, I need to subtract that $1 dividend, don't I? And when I subtract that $1 dividend, now my retained earnings is what? 9. If my retained earnings is 9, and I take 20 plus 7 plus 9, my stockholders' equity plus my liabilities equals 36, the balance sheet still balances, doesn't it? Now, do I have to pay a dividend? I don't have to, but if I choose to, and typically dividends are paid in the form of cash. I think I mentioned you could pay dividends in other forms, inventory, whatever. I could have sent out everybody a lemon for their dividend, okay? But instead, I paid $1 cash. The cash came down, and we subtract that dividend from our retained earnings. Okay? So let's understand retained earnings now. Retained earnings is basically the accumulation of the company's net income from the start of the company. We had what? 3 plus 7 gave us the 10, minus any dividends that have been paid out since the start of the company. That's how we get retained earnings. Think about the phrase, the words, whatever, retained earnings. It's your earnings, your net income that you have what? That you have retained, those that you haven't paid out in the form of dividends. Okay, so anytime you're trying to figure out the company's retained earnings, or if you're looking at a company's retained earnings, it is the what? It's the income that they've had since the very beginning of the company minus what? Minus any dividends, just very broadly speaking. Sometimes companies will do a reorganization, blah, blah, and they'll do some weird things with retained earnings way off the chart of this class. Okay, question? Okay, good. So let's go ahead and let's take a look now at our formula. Assets equal what? Liabilities plus stockholders' equity. We have said that our stockholders' equity is our common stock and our retained earnings, right? But how do we get to our retained earnings? Well, it's revenue minus expenses. Revenue minus expenses equals what? Net income. Good. So it's our what? It's our net incomes that have gone into retained earnings minus what? Minus out the dividends. Okay? Now, something interesting, right? Minus dividends. Something interesting about expenses and dividends. Let's compare those for a second. They both do what? They both reduce retained earnings, don't they? The expenses reduce retained earnings because it reduces net income. If net income decreases, then my retained earnings is going to decrease, isn't it? Or be less than it would have been if it weren't for the expenses. Dividends also reduce retained earnings. So what's the difference between the two? They both reduce retained earnings, don't they? Revenues minus expenses. If my expenses are more, my net income is less, isn't it? If my expenses are more, my net income is less. So what's the difference between revenue, expenses and dividends? Excuse me.
Stockholders value dividends over expenses.
Oh, well, that's a good observation. That's not what I was thinking. But yeah, the stockholders are going to probably be happy about dividends, not so happy about expenses. But that's not what I was thinking. But that's a good observation. Huh? Well, that's another good observation. Dividends, I don't have to pay them. Expenses, I mean, if I don't incur any expenses, I'm going to be sitting back in my house not having any money, right? Because you have to spend the money. So these are all great observations. None of them are worth thinking, but this is not a mind reading class, so go. What's the next one?
Expenses are used to cover costs, whereas dividends just go out to the stockholder.
Well, you're on the right track. Let me check with one more person. Huh? Yeah, expenses are expired economic benefit. We're incurring those costs to even generate the net income, right? Good. These are all thoughts that are actually bigger than the point that I'm trying to make, which is that expenses are reported on the income statement, aren't they? As a subtract from the revenue and the calculation of net income, which is where I think we were going with all this. Meanwhile, dividends are not reported on the income statement. They were subtracted straight from the retained earnings, weren't they? On that statement of retained earnings. So I think that's what you guys were saying actually in a more sophisticated way than the way I was thinking it. But a lot of times, the reason I point that out is a lot of times when students are first looking at that, and it's a reasonable mistake, if you want to call it that, that they think that dividends are reported on the income statement because they're doing the same thing to retain earnings as dividends are, but they're not. They are reported as a straight subtract from the retained earnings. Okay? Okay, good. Yes, sir. Dividends, that's a great question. Dividends are that are paid are not tax deductible to a company. Okay, the dividend income, however, is taxable to the receiver of the dividend. Okay, and so that's something that they complain about a lot. Corporations complain a lot about double taxation because you have to pay tax on your net income, don't you? But you don't subtract the dividend from net income. Okay, so it's not deductible for tax purposes. But then the corporation is seen as a separate legal entity by the IRS, and so the corporation has to pay tax on that net income. And then if you pay out a dividend, the recipient of the dividend has to pay tax on that dividend. And so that net income number got taxed twice, once when it was generated by the corporation, and then again when it was distributed to the shareholders. You pay tax on it again. So they call that double taxation. And that's somewhat of a problem. And that was part of the reason that they were giving for dropping the corporate tax rates from 35% to 20% in the tax cut law, and I put quotes around tax cut because the way they rolled out the tax cut was unprecedented in that they did it in a way where some states benefited from the tax cuts and some states got hurt by the tax cuts. Guess which states got hurt? You're sitting in it, okay? California was one of the main states that got hurt because they changed the law so that they limit the deductions that we could take for our state and local taxes. And in California, because you tend to have higher incomes and higher property values, they limited that to $10,000. I know I'm going to pay more tax next year as a result of that. So, meanwhile, if you were a state like Mississippi, where the property values aren't as high, you probably benefited from the tax cut because they increased what they call the standard deduction. And so it benefited the red states and it hurt the blue states. I wonder why. I guess to tell the blue states to vote red next time. I don't know what they were trying to convince us to do, other than cry, because we have to pay more taxes now. Okay, so anyway, more than you asked though, but they are not tax deductible. Okay, all right, good. Now you come over, revenue minus expenses equals net income. Net income adds to retained earnings. Dividends does what? Subtracts from the retained earnings. Okay. Okay, good. So again, let's look at these financial reports. Revenue minus expenses equals net income. Net income does what? Adds to the retained earnings. Any dividends for the period do what? Subtract from the retained earnings, gives us the ending balance in retained earnings. Then we go over to our balance sheet here, and we do what? We have our assets, cash, other assets, liabilities, our bills like accounts payable, and then we have our stockholders' equity, which is our common stock, and you can see the retained earnings coming down, right? In the balance sheet balances. Okay. Okay, now, you took a look at the way we did that little lemon tree example, and you're thinking to yourself, really? I mean, are we really that messy in accounting where we write numbers, we scratch them out, we erase them, we write them somewhere else? Where did I put that number? I think it's in my other pair of pants. Let me go get it. Okay, so what happens? The way we do this is we're going to systematically keep that balance, that equation in balance, asset equal liabilities plus stockholders' equity, by making sure that if we increase an asset, to keep it in balance, we have to do what? Either decrease another asset or increase a liability or increase stockholders' equity, don't we, in order for the thing to stay in balance? Okay? So what this little exercise is doing here is helping us to at least be somewhat systematic here as to how we keep this equation in balance. Okay? Now, we're going to go through this exercise here together, and it's not a bad thing for you to practice with, etc. But I want you to keep in the back of your mind, probably today, we're going to we'll start today talking about a system that's been around since the 12th century to help people keep this equation in balance at all times. And in my view, that is really the start of this course. Okay, this system that we're going to be using has been around since the 12th century, and we still use it today. Now, if a system has been around since the 12th century and it's still in use today, what does that tell you about that system? It must be effective. It's got to be effective, right? Or they would have come up with something better. For example, Roman numerals. I mean, that was all the rage at one time, wasn't it? But it's very ineffective to sit there and say, okay, divide, L I I X I X I by V I X I. Okay, yeah, I'll get back to you later on that, okay? So what happens? You come up with the Arabic systems much better, right? Hey, who cares about Roman numerals unless it's a Super Bowl, right? Okay? Now, so you have those sort of things that get thrown overboard when something's better. Accounting, 12th century Venice, they were using this same system that we're going to be talking about here in class today. Or maybe we'll get to it on Wednesday. But anyway, we're going to be talking about the same system. That's what we're going to be relying on. What's the second thing that you can surmise if something's being used since the 12th century? It's effective. What else? Exactly. It's got to be easy enough. I mean, if it was so complicated that, nobody could understand it, they would have said, you know what? This system is simply reflecting human activity, isn't it? I mean, it's not like, okay, well, if you want to build a house, you better build the house strong enough so the wind, which we can't control, won't blow it down. We have to live with that, don't we? But accounting is something that's reflecting something that we're doing. So if it wasn't easy to understand, they'd say, forget it. That's more trouble than doing the thing to begin with. So it's got to be simple. It's got to be what? It's got to be effective. So the system that we're going to be using is easy once you pay your dues. You are going to have to go through a certain amount of pain to understand how to use it, and then after you do that, it's not so bad. So if you're a driver, the first time you drove, you were probably like, oh my God, I can't do this, Dad. Get me out of this, right? Whereas what? Mom, I don't know. So this is terrible. Those cars are driving really, really fast. Now you sit there, if you're driving, get a little more experience, you're like, oh, okay, I got this, right? Okay? All right, so you'll see that that's the way that'll work. But right now, let's just go ahead and just practice with the notion using this little spreadsheet approach as to how this equation will work. Again, if you increase an asset, one of three things are going to happen. It's either going to decrease another asset, or it's going to do what? Increase a liability or increase stockholders' equity, right? Those are the only options to keep this in balance. So they tell us that this Ray and Barbara Neal decided to open a computer programming service, which he named Softbyte. And I'm like, well, geez, he's not a very nice guy. He just tells her what the name is. She might have said, bite this. I'm not going to call it Softbyte, right? And so he calls it Softbyte. I don't know why they did that. On September 1st, 2015, that was supposed to be funny. Okay, that he named it instead of talking to her about what the name should be. On September 1st, 2015, they invest $15,000 cash in exchange for stock. So if they put cash in the corporation, is the cash going to go up? Is the cash going to go up? Cash will go up. Cash will increase. If they have what? Taken stock in exchange, will the common stock go up? They took stock in exchange. The stock's going to go up, right? Just like when we issued $20 of stock in the lemon tree example. Is that what happened? Cash goes up. Common stock goes up. The equation stays in balance, doesn't it? Okay. All right, good. Transaction 2. They purchase equipment for cash. Now, equipment is something that is going to have future economic benefit, isn't it? I can continue to use it for whatever they're using it in this company for, computers or whatever. So is equipment an asset? So my what? Asset is going to go up, and they paid cash for it, so is my cash going to decrease? My cash will decrease. One asset increases, the other decreases. The equation stays in balance, doesn't it? Okay. Okay, good. Let's take a look at transaction 3. Stop me if you have a question, guys. This is a good time to kind of tease out any little boogeymen that might be in there messing with you on how this stuff works, okay? All right, good. So you come over, and we say that they purchase supplies on credit. What does that mean? If you purchase something on credit, means you're going to pay later, aren't you? Does that mean you're going to pay later if you purchase something on credit? Okay. Now let me say something about the way these transactions are described. This is the part that's sort of the little hidden problem that I have trouble realizing with my students. And because I look at something like that, and I have no doubt that that means that they didn't pay cash and they're going to pay later and it's going to generate a liability. I just know that when I read that. You look at that and you're like, how did I know that that was a liability? You need to ask me that kind of stuff. Do not be shy about asking me about those kind of things, because I won't always call those out because I don't always see it. I'm like, I've been looking at this stuff for 30 years. I had hair when I started this whole thing. I mean, a lot of things have changed, for me since that time when I first learned this. So I don't see it anymore as something that somebody could not possibly understand. So you need to call that out to me, okay? Help me out with that. But if it says purchase supplies on credit, that is the same as saying they're going to open up an account pay a bill in which they will pay later, just like we're going to pay the fertilizer person later, okay? So if that's the case, are my computer paper expected to last several months? That means it has future economic benefit, doesn't it? So is that an asset? That's what? Supplies. My asset supplies is going to go up. So either my liabilities are going to go up or my stockholders' equity are going to go up. Which do you think? Huh? My liability, my account payable is going to go up? Yes, sir.
If you buy something now, like the fertilizer that you're going to buy in a year, does that not present any problems when you have that money that you say you spent, but then you still have it because you're not paying it until the next year?
The question is, does it present a problem that I have a liability for something that I've already used up, if I may paraphrase? And it could present a potential problem if I get to a point where I'm ready to pay those bills and I don't have the sufficient current resource, liquid resource like cash to pay it. Absolutely. Think about it this way. Let's say you go out to dinner every night and you put the dinner on your credit card night after night after night, and then one day you get the bill and you're like, I don't have enough cash to pay this bill. Let's see. Let me go back to the restaurants and return the dinner. Okay, that's not happening, right? And so what's happening? You've got a problem because you've consumed a resource and you don't have the cash to pay for that liability on it. So yes, it could present a problem. So a entity, any entity, a human being, a household, a business has to be careful not to let its liabilities get to a point where it doesn't have sufficient resources to pay those. And we have a way of measuring that. It's something called the current ratio that we'll study towards the end of chapter 3. The current ratio is a way of seeing that your current obligations are not growing, so that you don't have the current resources to pay for them. And we'll talk more about that. So what did we say on this one? The liabilities are going to increase. The accounts payable. Right? Okay, good. Now notice, guys, that under our categories, assets, liabilities, stockholders' equity, we have accounts. See the accounts that are underneath them? So typically when we talk about what's going to increase, what's going to decrease, we talk about it in terms of the account, right? So accounts pay a bill increase, which is a liability, and what? Our assets, supplies increased. Okay? Okay, good. Next transaction, services provided for cash. Services provided for cash. Is my cash going to increase? This is what I love about accounting. If you can figure out one of the accounts, then you can kind of back in, sit there and help yourself figure out what the other account is, right? So we know cash has to increase. We got half the job done here. What other accounts now must decrease or increase. Either another asset's going to have to decrease or a liability is going to have to increase. But we just provided service. If you provide service for someone, do you expect to get paid? Do you expect them to give you money and you feel like you're richer as a result? So if we're going to be richer as a result, we're thinking our net income is going to come up, isn't it? And how does our net income go up? By our revenues increasing, right? So it's got to be that revenues are going to increase. Okay? And the equation stays in balance. Our cash increases. Our stockholders' equity increases. How does the stockholders' equity increase? Stockholders' equity increases because revenue increased. If revenue increases, net income increases. If net income increases, retained earnings increases. If retained earnings increases, what are our two stockholders' equity accounts? Common stock and retained earnings. So stockholders' equity increased, right? Okay. Let me communicate that another way. Let's make an income statement. Let's make an income statement, boys and girls, shall we? Okay. You guys don't know Mr. Rogers is, do you? And they're going to make a movie out of Mr. Rogers? Did they have Mr. Rogers when you were a kid? No? I think he was already dead, so probably not. Okay. Income statement. And when we make up our income statement, what's on our income statement? Revenues minus expenses equals net income, doesn't it? Okay. So we just increased our revenue $1,200, didn't we? Right now our expenses are how much? 0. So our net income then is going to be $1,200, isn't it? Okay. Now if we made up our statement of retained earnings right now, since they just started business, the beginning balance in our statement of retained earnings is 0. We add what? We add the net income. Net income is $1,200. And that we know of right now, our dividends are subtract. Let me put an S there for subtract. Our subtract is what? Dividends right now is 0. So my retained earnings is $1,200, isn't it? So my retained earnings increased $1,200. My retained earnings is part of my stockholders' equity. So the equation stayed in balance through the calculation of net income. Okay? All right. I don't know how awe-inspiring that was for you. Did you not get a chance to write it all down? You want me to write it again? I probably erased it too fast. You're good? Okay? All right, good. Now you come over and you take a look at the next transaction now. And Softbyte receives a bill for $250 from the Daily News for advertising, but postpones payment until later. If we're going to postpone payment until later, do we have an increase in our liabilities, our bills? So we know the liabilities are going to go up $250, aren't they? Okay, but what about this advertising? Now you look at this advertising and you're thinking, well, this might have future economic benefit. People hear the ad today, they come in and they buy the stuff tomorrow, don't they? So you're kind of torn. You're like, well, wait a minute. Let's say I play the ad around holiday time, around Christmas, whatever. I play the ad in anticipation that people will come in and buy holiday gifts, right? But when the people hear my advertising, they say, oh, I would have loved to have bought one of those for my boyfriend, girlfriend, whatever, but I already got their Christmas present. I know. I'll go back in there in February and I'll buy it for Valentine's Day. So when that ad is playing, do we know if it has future economic benefit or not? Could have future economic benefit. Maybe some people sit there and say, I don't go in that store. I don't like that store, right? So if that's the case, FASB, the Financial Accounting Standards Board, tells us under the rule of conservatism, if you don't know that something has future economic benefit, expense it. Treat it as an expired cost. There's no benefit to that, just expense it. So that we don't get into the wild speculation where everybody starts using their imagination as to whether it has economic benefit. FASB says we're cutting that off. We're just going to what? Tell you what to do with it. You will expense it. So we know that what? Our liabilities will go up. So our stockholders' equity is going to have to come down, isn't it? So when my stockholders' equity comes down, in this case, my expenses are going up, which is causing my net income to come down, which is causing my retained earnings to come down, which is causing my stockholders' equity to come down. The equation stayed in balance. Liabilities went up. Stockholders' equity came down, didn't it? Yes, sir.
So the reason that the 1600 from before doesn't go into the stockholders' equity is because it has future economic benefit?
Yes. The reason the supplies of 1600 right here, the reason, same thing as equipment. It had future economic benefit. So both of those, with the 1600 for the supplies, it said it was expected to last several months, which caused it to be treated as an asset because it had future economic benefit. If it does, if we spend some money or incur a liability for something that doesn't have future economic benefit, we treat it as an expense because it has expired. The future economic benefits expire. What happens when somebody dies? They say what? Oh, so-and-so expired at 11:45 today. What does that mean? That means they have no more future economic benefit. They have no more future. They have nothing left, right? And so if it expires, that's saying there's no more benefit left to it, right? Okay? Okay, good. Now you come over, and where was that, 250? Okay, and I'm just going to go ahead and bear with me, guys. I'm sure you realize this, but let's just visualize it. I'm going to prepare the income statement again now with this what? With this expense. Okay, so what happens? My revenue is 1200. Now my expenses, and they went from 0 before. Weren't they 0 before? But now they are 250, aren't they? They were 0 before, and now they're 250. So my net income is how much? And you know what's coming, guys. I'm not going to be able to calculate unless you help me out with it. 950. Okay, so my net income is now 950. Before it was 1200, wasn't it? Before it was 1200? Okay, and so what happens when I prepare my statement of retained earnings this time, my beginning balance would still be 0. My net income for this year, let's just keep doing that little mnemonic. I add my net income now for this year is what, 950? It was 1200, but my net income went down, didn't it? So the ending balance, I don't have any dividends right now, my subtracts. Still saying the dividend is 0. So the ending balance, I keep writing 2 N's for ending balance, is 950, isn't it? So it's true that my retained earnings came down because my expenses went up. Expenses go up, net income comes down, retained earnings comes down, stockholders' equity goes down, the equation stays in balance. Yes, sir. This one? Well, they're showing it, and that's why I'm doing this, they're showing it as a negative because it reduced my stockholders' equity. This thing's at a high level is trying to keep the equation in balance. So they're showing it as a minus to indicate to you that it reduced the stockholders' equity. But that's why I'm doing this, because that gets a little confusing, right? You're asking the question. Well, there's a minus, no, I don't see 2 minus signs. The liabilities went up, right? Liabilities increased, and to keep the equation in balance, stockholders' equity came down, didn't it? That's what that minus is indicating, is that stockholders' equity came down. But I'm telling you that actually expenses increased, which decreased my net income, which decreased my stockholders' equity, right? It's just sort of the way they presented it more than anything, but they're just trying to show you the equation assets equal liabilities plus stockholders' equity there. Yes, sir.
In terms of expense, how come the $7,000 worth of equipment is under cash expense?
It's an asset equipment. When we spent the $7,000 on this equipment, it's another asset that it went towards. It didn't go towards an expense. It went towards equipment. Equipment is an asset, has future economic benefit, so we don't treat it as an expense because it still has benefit in the future to it, so it needs to be recorded as an asset.
I mean, the negative 7,000 under cash could be a positive 7,000.
That's exactly what I just answered. The $7,000 cash came down, right? That minus because we spent $7,000 on equipment. And our options are another asset can go up, a liability can come down, or our stockholders' equity can go up as a result of selling this cash to keep the equation in balance. Let me say that again. Our cash came down. Our assets came down. I misspoke. Our choices are liabilities can go up, or our stockholders' equity can go up, or another asset can come up, right? And so we spend $7,000 on equipment, and equipment is an asset because we can use it for several years. It has future economic benefit. So cash came down, equipment went up, the equation stayed in balance, right? Right? Okay. Yes, sir.
Like, say in 5 years or so, they need to upgrade all of their computers. Would they then, at that point, like if they had to spend another $7,000 to buy updated computers, would they subtract the original 7,000 for the equipment and put that in expenses?
Yes, with an important point of clarification on that. Because equipment typically doesn't expire all at once, unless there's a flood or something that destroys it, we have something that we call depreciation, which allows us to ratably show each year how much of the future economic benefit of that equipment has expired, and we'll take a little bit each year, and possibly by the end of the third year or something, the equipment account will be down to zero, and then we would replace it with new equipment.
So for the depreciation, you'd put that in the expenses?
As it depreciates, yes, we would go ahead and reduce the carrying value of the equipment on the balance sheet year to year and show a little bit of depreciation expense on the income statement year to year. That's correct. And we'll get heavily into that in Chapter 8, I think, as to how that whole process is supposed to work. We're good now on this? Okay. Okay, good. So we're sitting here, and I'm going to get rid of this. It's going to be in the way now. I'm trying to finish this exercise, and it's futile at this point. Do you want to take the break right now? Because I was trying to finish it by the break, before the break, but that's not happening. So let's just go ahead and wait till to come back in 10 minutes, okay? Let's take 10 minutes. We'll come back at 11, and I'm seeing now what's going to happen is we'll at least finish this exercise, maybe see a couple quiz questions, and then we'll pick up, obviously, on Wednesday. So go ahead, guys, and we'll pause here for about 10 minutes. How you doing? Yeah. Hang on. Let me pause this. Okay, guys, let's go ahead and get started back, and I'm revising the goal for today, which is going to be to get through this exercise here, and then I'm going to show you a couple of the quiz questions, and that'll get you started on those. I want you to then look at those, please, later today, tomorrow, but definitely before Wednesday's class, but then we'll go through every one of the questions together in detail, okay? All right, so that's the game plan. See if we can get through this and get the quiz started. And I got to get back in. At least I get some exercise, right? Going up and down this thing. Okay, and let's go ahead and catch ourselves up. I think we were right here. Okay, so what happens? Now they tell us that the Softbyte company, whatever, provides some service for customers. If you provide service for customers, you are generating revenue in your business, right? Okay, so they say that they do $3,500 worth of program services, so we know that the revenue is going to go up $3,500, isn't it? Right? Now, notice they say that some customers pay us cash up front, $1,500. So we know that the cash is going to go up $1,500. Our asset cash is going to go up $1,500. The remaining, what, $2,000 that they say is paid on account. And when you see that phrase that it is paid on account, that is telling them that they're going to pay you later. You're going to receive the money later. Okay, so we're going to have an asset called accounts receivable that will also go up here for the remaining $2,000 that we'll receive later. If someone's going to pay you later, is that a future economic benefit? We call that kind of future economic benefit accounts receivable. So our revenues go up. Obviously, our cash goes up by the $1,500 cash they are going to pay us. But the $2,000 that they'll pay later, it's still an asset. It's not my favorite asset. It's potentially my second favorite asset now, though, which is what? Money that's coming pretty soon? Maybe in 30 days or so? Okay. Now, important takeaway from this transaction, guys. Notice that what? Have we already provided the service? We've already provided the service, so we took the revenue because the service has been provided, even though we're not going to be paid the full amount until what? Later. So receiving cash is not what generates the recognition of the revenue. It's the performance of the service, isn't it? Okay. Contrast that with what happened with the fertilizer. We weren't going to pay the person until what? Until later, but we took the expense now, didn't we? Because the future economic benefit had expired, so we took the expense. This process is called accrual accounting. That's what we're studying in this class. It's called accrual, not cruel accounting, but accrual accounting. We don't worry about when the cash came in, when it went out, in order to determine whether we should recognize a revenue or an expense. Okay? Okay, good. Come over and let's take a look. Any question on that? Guys, stop me if there's a question, because I get talking about accounting, man, and I roll. You know, you should hear me talking to accounting to my friends like on a Sunday while we're trying to watch football. No, I'm just kidding. I don't talk about accounting there. Okay, so what happens? We sit here and we have what? Softbyte, and it pays the following expenses in cash: store rent, salaries and wages, utilities. So obviously my cash is going to go down, isn't it? And my expenses are going to go up. When my expenses go up, my net income comes down. If my net income comes down, my retained earnings comes down. If my retained earnings comes down, my stockholders' equity comes down, doesn't it? To keep the equation in balance? Good. Okay, then what? Then we pay that $250 liability. This is an easy one for you guys. What's going to happen to the cash if you pay? If you pay cash, what happens to your cash? It goes down. If you are paying a bill, then the bill should come down too, shouldn't it? So my accounts payable bill will come down. My cash will come down $250. Good. Okay, I make that point. If you pay cash, does your cash come down? Because I'll get students sometimes will come to me and say, well, how do I know the cash went down? And I'll say, because it says they paid the cash. Okay, so sometimes when you're trying to learn this stuff, you're going, 50 miles an hour and you miss the exit because you were going too fast. Okay, so that's why I slow down and point that out. If you pay cash, your cash comes down, right? Okay, okay, good. Come over and let's take a look at receiving cash now. I get paid $600 of that accounts receivable. So they're paying me, right? So what's going to happen if someone pays you? Cash good will increase, and the accounts receivable should come down, shouldn't it? And so the accounts receivable does what? Sure enough, came down, doesn't it? How much do these people owe us? Huh? Who said $1,400? They owe us $1,400, don't they? How do we know? We had accounts receivable of $2,000. It's come down $600. They owe us $1,400, don't they? I'm going to argue that this is why they invented accounting back in the 12th century. So that, I guess in those days, they didn't have telephones, so I guess they would have yelled out the window, "Hey, Giovanni, how much do I owe you?" I'm saying Giovanni because it was in Italy where they first started talking about double entry. "Giovanni, how much do I owe you?" And it was very easy for the other person to yell back, "You owe me $1,400. Because it's right there, isn't it? You don't want to be in a situation where you sit there and go, hang on a minute. You owe me money? Hang on a minute. So the person's like, he doesn't know how much we owe him. Just send him $50. He'll shut up. Okay, so what happens? They really invented accounting for these kinds of settlements of accounts, etc. That is what I'm arguing. Okay? Okay, good. So now we owe $1,400. Next any question on that? Next transaction. Okay? We pay a dividend. If I pay a dividend, is my cash going to come down? $1,300 dividend, is the cash going to come down? Cash will come down. My what? My dividends will go up, so my retained earnings will come down, so my stockholders' equity will come down, and the equation will stay in balance, won't it? That 1,300. And then we have the ending balances in these accounts. So now we can use this to prepare our financial statements. So let's look at them. Revenues were $4,700, weren't they? Right here, revenues. Bottom line down here, $4,700. Were our revenues $4,700? So when we prepare our income statement, we can show revenues of what? $4,700. Then what? Then we had the expenses. Remember all those expenses? The expenses were what? This is kind of a thing where it helps if we click back and forth. The expenses were $1,950. Were those the expenses? And so when you look at the income statement, when we look at the expenses are $1,950. Net income is $2,750, isn't it? We go to our statement of retained earnings. Beginning balance was 0. They just started the business. We have our net income increases the retained earnings, $2,750. And then remember, we paid that $1,300 dividend, didn't we? The $1,300 dividend. So we subtract $1,300 from retained earnings for the dividend, right? And we get the ending balance of retained earnings. We take the ending balance to retained earnings to our balance sheet. There's our cash. Our cash was $8,050. See the cash, $8,050? You go back to that little spreadsheet exercise. There's the cash amount, $8,050. $1,400 for the receivables, $1,600 for the supplies, etc. So there's all of our assets. There's our liability, which was 1,600 accounts payable. There's our common stock, 15,000. Remember when they started the company, it was 15,000 in common stock? That stayed the same. The retained earnings now, ending balance, comes down to the balance sheet. Does the balance sheet balance? Okay? Okay, good. Now we're going to be doing another exercise probably next time in which we're going to go into using the actual system that we have designed so that this whole process is a little easier. Okay? You know, let's go ahead and do this, and then we'll just start the quiz together next time rather than me sit here and start the quiz with you. So just take a look at the quiz, but we'll do it together entirely next time. But let's talk a little bit about ethics, okay? I had forgotten these slides were here, and this is an important subject because you see where you can make a mistake even. And if it's seen as an ethical violation, we were just talking about Musk and the problem that he's having now, right? Okay? So with an ethical violation or an ethical dilemma, what I think we sometimes tend to think is, oh, that'll never happen to me because I'm an ethical person and I'm just not going to get involved in those kind of things, right? The problem is that the ethical dilemma often chooses you. You don't get to choose it. It chooses you. And the question is, do you know how to deal with an ethical dilemma if it arises? And I even shouldn't really say if it arises. I really should say when it arises, because it will happen. It will happen. It's something that shows up on a Thursday afternoon when you're like, huh? How did I find myself in this all of a sudden? Okay? So, one of the key things to me in dealing with an ethical dilemma is disclosure. Disclosure, 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 early and often if you run into some sort of ethical dilemma. Let those around you know what is going on and deal with it in the light of day. Okay, a common mistake is an ethical dilemma comes up and you're not sure what to do, and so you keep it and you internalize it and you keep trying to figure out a way that it'll just go away, and it won't. It's like when you're in the restroom and a piece of paper sticks to your shoe and you keep trying to get rid of this stupid thing and then it gets on the other shoe, and no matter what you do, it seems to still want to stay there. Okay, this is how ethical dilemmas can be with you. The sooner you disclose, the better. Okay, so let me ask, does anyone have an ethical dilemma that you want to share with us with the time we have left? And please don't give me a moment of personal indiscretion. That's not what I'm looking for. You don't say, well, gee, the night started out, and my friend and their date, and somehow I was the one that the date liked better. I don't want to hear that. But if it's something that's, okay in class here, no, nobody ever does. Okay, so I'll tell you mine. Okay? I was on an assignment. We were looking at the U.S. Forest Service, GAO, Government Accountability Office. We're looking at the U.S. Forest Service financial reports. Okay? And when I looked at their depreciation system, although when you're talking about a natural resource, they call it depletion. When I looked at their depletion system, they were including in their pool of costs. They would take all the costs of the forest, put them in a pool, and deplete that over 100 years. They figured 100 years from the time that you first plant a sapling to where it's ready for harvest for timber, right? And what they do is they sell parcels of the forest off to timber companies that then take that for timber, and that comes into the federal coffers. So obviously what? When they sell that timber, they don't want to sell it for less than its cost, right? So they have to make sure they know the cost, probably sell it for more than its cost, so the government turns a little profit on that, okay? So what happens? I'm looking at their cost accounting system, and in that 100-year pool, they include roads, they include things like drainage systems as part of those costs. Now, does a road have a 100-year life? No. Does a drainage system have a 100-year life? No. So they're depleting that over too long of a period, thus making the cost of the forest less than it should be. So I went in and I said, hey, we have this finding. Am I understanding it correctly that you're doing this? Why are you doing this? Isn't this understanding the cost of the forest? They say, yes, 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 but you can't criticize us, GAO, because you were here 3 years ago. Not me. Another team was here 3 years ago when we put this system in place, and nobody raised it then. So how can you be raising it now? It was essentially signed off on back then. So I'm like, okay, I guess maybe they have a point. So I go to my boss and I say, this is what they're saying. He says, I don't know what to do about that. If somebody else in GAO said it was okay before, we're saying it's a problem now, yeah, that can be embarrassing. So we keep going. It keeps going up the chain, and finally it gets up to the Comptroller General of the United States. Comptroller General of the United States is an appointed office. It's a 15-year appointment. They are nominated by the President, confirmed by the Senate to a 15-year term. Why 15 years? Huh? Yeah, to maintain the independence, right? Hey, I don't have to worry about an election or something. I got a 15-year term, right? And usually the person's of age that they're going to retire out of that job, essentially, right? Okay? And so what happens? Comptroller General looks at that, comes down and says, tell the Forest Service that was then and this is now, essentially. We don't care what we said 3 years ago. We're going to come out with this in our report that this is a problem what they're doing now. So we come out with the report, and Forest Service criticized us. They said, hey, GAO, make up your mind. You were here 3 years ago, now you're saying this. So we took a little bit of egg, right, a little bit of hit for that. Now, what would have been the alternative? Alternative would have been to say, oh, okay, well, we better not say anything since we didn't say anything 3 years ago. Environmental group finds out that we were aware of that finding and we were understating the cost of the forest and did nothing about it. That's a much bigger problem than to endure what? Some criticism from an agency that we're supposed to be auditing anyway. Okay? So you run into things like that from time to time. And you think I walked into that office thinking, oh boy, here's my ethical dilemma day. You all of a sudden you're like, oh wow, here it is. I've got to make some sort of decision. Your best bet, guys, especially early in your career, disclose earlier and often. Get it out there. Nobody expects you to be the one that knows the answer to things like this. Okay? All right, guys, that's enough. It looks like we're wrapping up. So we will make sure you signed in, and we will go through the quiz first thing on Wednesday and then get into Chapter 2, all right?
Is there a way to see the quiz without the highlighting?
If you get the Word file, it's easy to unhighlight. It's just for this chapter, I embedded them in the slides, and I do that sometimes. Usually it's a separate Word file, but that Chapter 1 quiz has a separate Word file. Just unhighlight them. Yeah.
Are you still okay to hold?
Yeah, yeah.
Each class? Okay,
Yeah, I'll
cool.
carry it class to class. Yeah,
Awesome.
not a problem.
And this was just through the first midterm. I just figured that was easiest.
Oh, okay. Okay.
Because that was when we were going to enter them into Canvas.
Okay, that's fine. Yeah, that'll work.
Let me know if you need
Let me pause this, guys, so that we don't... Oh, you want to sign this? Oh, okay, sorry. I just want to pause this so we don't have to record our whole...
Otherwise, I will bring the copies on Wednesday.
Okay, great. Thank you, Amanda.